which I think is probably a good segue into our main topic. What do you think?
I think so. It's the goal for this week was just to kind of take a look a little bit at the public markets and what we've seen with the significant sell-offs and the significant decline of global markets around the world. Specifically, we focus here on the U.S. markets because it's what we're most familiar with, but it's also just the largest financial center around the world. So I think it's an interesting comparison to take a look at the public markets versus the private. And I'm certainly happy to start it off by looking at, first we wanted to compare how the public markets have tanked in the last 4 to 5 weeks versus the security token market. And so when we take a look at the S&P 500, it's down about 35% versus the security token market, which is down about 32%. So it does, Herwig, seem to mimic what we're seeing in the public markets, which I guess makes sense.
Yeah, that doesn't not necessarily surprise. I think with anything, if we were to capture a third side of the market, the actual private market versus the private tokenized market, we'd find that it's fascinating to see that it's mirroring a public market, because I would hypothesize that the private market is potentially an even worse situation due to liquidity premiums and the like. So the fact that the security token market is mimicking the public market, I think is actually a strong sign that the technology is working and that assets aren't necessarily suffering from specific liquidity issues or premiums.
Absolutely. And we've seen even some issued security tokens that have totally moved against the general trends in the public markets, specifically real estate. And so, what we tried to do here was take a look at how the REITs were affected, which is really the only public market equivalent to some of these fractionalized real estate opportunities, and then compare that to some of the realty tokens that have been issued. And it was very interesting. When we look at some of the top REITs in the world, or at least in the New York Stock Exchange, we have the American Tower REIT, which is the largest, which is the ticker AMT. We've got Crown Castle, which is CCI. We've got Prologis, which is PLD, and then Simon Property Group, which is SPG on the public markets. And so those are the top 4 REITs. And so I took a look at those. And what we saw from those is that AMT is down 27%, CCI is down 30%, PLD is down 34%, and SPG is down 66% just in the last month. So these REITs have been taking a beating. And it's interesting because we've always heard that real estate is that kind of safe asset or less risky than the stock markets and things like that. But certainly the REITs themselves have really struggled to hold any semblance of value, which is fascinating, especially when we compare that to realty. I took a look at the realty properties and conducted a weighted average calculation across the 6 live properties and found that across the 6 properties, weighted by market size or market cap rather, they're up 2.12% since the same time frame. Over the last month, the properties are up 2%, and that's in equity value, not counting the daily dividend, which pays out double digits on a yearly basis. So investors probably are up 2 to 3, maybe 3 to 4% in the last month, versus investors in REITs that are down anywhere from 30 to 66% in the same time frame. That's pretty interesting, Herwig.
Now, that's an incredible insight. Absolutely. I mean, what you're essentially saying is that instead of paying somebody to be a manager for a group of, real estate projects, I myself can just go own these 6 tokens, and I'd actually be doing better than I would be holding onto that REIT. And there's definitely obviously a lot of different factors that that come equated into this. Of course, people want liquidity, and so a lot of people hold REITs and are perhaps looking to move it out of that as a portfolio strategy. Realty is also interesting because it offers that daily dividend, which is not something that REITs offer. So it's very, very interesting to see, that at least in this case, realty is actually defying what the public markets is doing. And we know it's a small sample size. We're only talking about a few million in real estate value. But in the end, definitely still an interesting insight.
Absolutely. So it's fascinating. And I like what you said a lot about personally owning those properties. It's we'll have to see how this continues. We'll certainly monitor the realty properties and maybe compare that to REITs in another month or in 2 months and see if the same kind of differences apply or if they end up following suit.
Definitely a useful exercise. And it's worth pointing out, Kyle, that a REIT as a real estate investment trust is different than owning the properties themselves. So perhaps the REIT's underlying portfolio is maintaining the value, but it's certainly the fund on the public market is not. So definitely I think it's a good, interesting exercise to do in a couple months.
Another good point. Definitely. We'll have to see if those tend to rebound or if they continue to struggle and maybe try to analyze why that's happening. So it's fascinating stuff. On top of that, we wanted to take a look at the movement of money. And so everyone seems to be rushing into treasuries, but we wanted to look at gold, maybe silver, and compare that to some of the stablecoin volumes over the last month and see what that looked like. So I also took a look into those. From my research, it looks like gold is down 8.5%. Silver is down 15.3%. Bitcoin, obviously, most people listening to the podcast may be familiar, is down almost 35% in the last month, as well as stablecoin volume itself is down around 37%. So obviously, with a stablecoin, it is pegged to the dollar, so the price itself hasn't changed. But what we can measure is the volume of transactions leveraging stablecoins because they're all built on public blockchains. So the transactions themselves can be monitored by research firms. And so what we found from Masari Crypto is that the stablecoin volume over the past month is down just over 37%.
And now I think that one's also really interesting, Kyle, because I think it makes sense that some of these commodities that you pointed out are headed downwards or seeing some kind of a correction, if you will. But there are, a lot of movement going into treasuries, safe hard assets, et cetera. You would think that maybe some of these stablecoin pegged to some of these potential bonds or safer assets and things like that, or even currencies, would actually see an increase in volume. And we're seeing a very correlated to the market drop as well. So, had you asked the question to me ahead of the show, I probably would have expected maybe stablecoin volume to remain the same or potentially even go up. But it's very clear that perhaps there aren't the right stablecoins, or perhaps the infrastructure there isn't quite ready to support, an economic crash like this data suggests. And in fact, there was a Paxos article on securities.io talking about how they're seeing adoption of their gold-backed stablecoin and their Pax stablecoin as well. But ultimately, this data suggests quite the opposite, that is indeed not the case. And in fact, stablecoins may face some trouble in the coming markets.
Yeah, it's interesting. We definitely, I think, should revisit this topic in a little while or potentially even monthly or something like that while we're going through this turbulent economic time to continue to compare these things, because it will be interesting to see if a lot of the reasons behind this are due to the initial fear, that initial scare, or the initial fleeing of a lot of the riskier alternative investments that we then see kind of come back after the market's relatively stable out. Certainly any time of where we're seeing the markets decline by 5, 10, 15% in a matter of a week, you're not going to have rationally moving markets. So it will be fascinating to see over time if these same trends are maintained or if we see some kind of different pattern emerge in a more rational market.
Definitely sounds like there's demand for an update on this segment, main topic here in a couple months for sure. But lastly, I do want to take one last look. Of course, IPOs have definitely frozen or dried up, if you will, amongst all this madness. And we're still seeing a lot of new STOs announced. You just announced yours. We announced one last week. We're still seeing a lot of activity. But I will say that we still haven't seen any successful closings, so that might be more closely correlated to the public markets as well. There, we'll be sure to review that in the update, I guess, as well, to see if the fundraising potential or momentum, if you will, for security tokens has slowed compared, of course, to their IPO counterpart.
Unfortunately, I think in turbulent economic times that can be expected, is that the risk capital seems to be less and less intense. There's less appetite for earlier and earlier investments. But at the same time, there does seem to be a lot of demand for new and interesting vehicles, certainly things that are less correlated to the public markets that maybe are overinflated or over leveraged. So I still have tremendous hope, and I'm very confident that the technology and the structure continues to improve every day, and it's only a matter of time until we start to see more and more successful offerings. So I have not changed my opinion on the markets and where this is going, and I certainly know that you haven't either, Herwig.
I think it's very clear, Kyle, as more and more assets and security tokens enter the industry, we are able to garner more and more insights, and it's very clear that they are here to stay, and they are here to play, if you will, as part of the overall economic infrastructure of the world.
Yeah, if anything, this is what we're seeing in the public markets is actually even more justification for why we need accountability on the scale of security tokens in terms of having these public ledgers and being able to track and log these things across all jurisdictions and building a more structurally sound financial system without relying on some of these over-leveraged firms. So it'll be very interesting to see. But with that's about all from me. We covered our 40-minute episode. You better believe that we're coming back with all of the top news every week. You may not have a commute to listen to since you're chilling at home, but hopefully you enjoyed the episode. Hopefully you'll give us some feedback, potentially send us some articles, tell us what you liked, what you didn't like, what you want to see in the future. And that's about it from me.
Thanks for listening. Hope to catch you next week.